A few months back, actually an year ago, Sharat Chandra posted a tweet which caught our attention. It said in a single line, the Parag Parikh Flexi Cap fund is a glorified asset allocator. And my first reaction was, how dare he? After all, here's a fund which has delivered yearly returns of 19% since inception, has been regularly featured in any list of India's top 10 mutual funds. It's a fund that manages 22,000 crores in assets. It practices the value style of investing and is the first scheme that comes to mind when we think of a hybrid domestic plus international investing strategy. Point blank, the fund has done extremely well for its investors, including me, but according to Sharat and his analysis, anyone, yes, anyone can easily duplicate the performance of the Parag Parikh Flexi Cap fund. And so in this video, we'll examine what this ruckus is all about and what we can learn from it. Let's begin. The Parag Parikh Flexi Cap fund follows an allocation pattern which allows them to have up to 100% of their assets in domestic equities and, more importantly, up to 35% in foreign equity instruments. This is listed in their key information memorandum, and on its part, the scheme has always maintained an international allocation of at least 20% since its inception. In fact, the scheme has about 60% of its assets in domestic stocks, about 6% in arbitrage funds, another 6% in liquid assets, and the remaining 27-28% in international equities. Now, this combination of asset classes has helped the fund deliver above benchmark returns in most years. And I'm sure you'll agree that the Nifty 500 isn't really an acceptable benchmark for any fund that keeps around 28% of its assets in foreign stocks, which means we have to tweak the benchmark a bit, and we'll take what Sharat took in his analysis, that is a 65% allocation to the Nifty 500 and a 35% allocation to the Nasdaq 100. Now, one might say, why use the Nasdaq 100? And I agree with Sharat, as the Parag Parikh Flexi Cap fund has consistently invested and held on to stocks in big names like Microsoft, Facebook, and Alphabet, which occupy a significant portion of the Nasdaq. Right, so let's map the Nasdaq 100 returns to this table, and we can already start seeing a pattern. In fact, when we apply a lazy 65-35 allocation on this very data, one can observe that the big variations we saw between the Flexi Cap fund's performance and the Nifty 500 have now subsided quite a bit, with the years 2014 and 2021 being the notable exceptions. Other than these 2 years, the variation between the Flexi Cap fund and the 65-35 combination has been a very tight range, which is odd for an actively managed fund like the PPFAS Flexi Cap fund, which can choose stocks across market caps and sectors and has access to a larger universe of investable companies. But Sharat didn't just allocate capital across these two indices in his analysis, but he did something that we, through our videos and our Genius offering, have always been saying, that is, it is not enough to allocate assets, but you have to rebalance them from time to time. So per his newsletter, Sharat rebalanced on a monthly basis, thereby ensuring that the proportion of Nifty 500 and Nasdaq 100 remains in a 65-35 ratio at the beginning of every month. Okay, so here's how this panned out. This line here shows the relative NAV of Parag Parikh Flexi Cap Fund's regular plan. Of course, we have set it to a base of 1 rather than using the traditional NAV of 10 rupees. Now, during the same period, here's how the Nifty 500 has moved, and here's how the Nasdaq 100 has performed. Now, this represented data extends from the inception of the Flexi Cap fund in May 2013 until March of 2021. So firstly, it is not updated for the last year or so, and secondly, since we are using relative values, there is likely to be some timing bias as well. For instance, between May of 2013 until December of that same year, the PPFAS fund grew by 11% in absolute terms, while the Nasdaq 100 jumped by over 21%, which is a big difference. And honestly, these things really add up and they matter in relative measurements, but let's not complicate with this. So the meat of the matter is, how did the rebalanced 65-35 benchmark perform? And abracadabra, here it is. Notice here that the Parag Parikh FlexiCap Fund's monthly NAV is tightly correlated with the performance of the 65-35 benchmark index, which effectively means that the 65-35 combination of the Nifty 500 and Nasdaq 100 could conveniently and efficiently clone the performance of the Parag Parikh FlexiCap Fund. In fact, Sharat adds a little spice to it in his newsletter when he says there is zero work actually being done by the fund manager, which is another way of saying that the fund managers are glorified automatic rebalancers. Now, I'm sure he doesn't mean it the way it's written, but he does touch upon an important point of closet indexing, which should be considered by every investor when laying out their mutual fund investing strategy. Now, for any fund that performs as good or as bad as the Nifty 500 index, one should consider the fact that the fund managers never actively invest in 500 stocks but do so in a much smaller number. In that context, if someone were to say that the PPFAS FlexiCap fund's performance is close to the Nifty 500, my argument would be that the fund had not invested in 500 stocks but had almost always held between 20 to 25 stocks in its portfolio. Of course, the next argument could have been that those 20-25 stocks are the highest weighted stocks amongst the Nifty 500 companies. But as this data shows, this isn't really the case, and the Parag Parikh FlexiCap Fund continues to invest in its sector and capitalization agnostic style. A similar pattern shows up in case of international stocks, with the FlexiCap Fund investing in only 5 stocks from the basket of 100 that comprises the Nasdaq 100 index. In our opinion, while the performance matches, there doesn't seem to be any intent of closet indexing with the Parag Parikh FlexiCap Fund. In fact, the argument in favor of the PPFAS fund managers is that they had the gumption and conviction to invest in foreign stocks when every fund house was sticking to domestic stocks. But that doesn't mean that closet indexing is not there in the Indian mutual fund space. In fact, I'll argue that this trend is on the rise as fund managers find it continually difficult to beat the benchmark, as this S&P Dow Jones Indices authored SPIVA report shows. The 5-year analysis here is rather damning, as it shows that about 80% of actively managed large cap funds and ALSS funds have failed to beat their comparison benchmark. Now, one way of checking for closet indexing is to look at the scheme's R-squared. The R-squared measures the correlation of the portfolio returns with the benchmark returns, which is then expressed as a percentage from 1 to 100. But correlation and causality are two different things, and as we saw in the case of the Parag Parikh FlexiCap Fund, it's possible that while a fund has a high R-squared, it can still have a very different portfolio makeup as compared to its benchmark index. So these are some things that you might want to look at, but the lesson is don't get swayed by the term actively managed fund as if the fund management team is destined to deliver above average returns. On most occasions, the fund managers fail to beat the stock market, and in that context, you might have to get a bit more detailed in your assessment of funds. I personally have half my SIPs in active funds and half in passive funds, and I try to evaluate the active funds based on alternative strategies like the investing style, the type of strategies employed, the kind of opportunities that the fund operates in, etc. As an investor, it does take some time and effort to understand these specificities, but if it interests you, then start off by watching our analysis of the HDFC Top 100 Fund, the Axis Long-Term Equity Fund, and the investing strategies of quant mutual funds to get a head start. And with this, we come to the end of this video. If you'd like to join Sharat's community, then do subscribe to his newsletter. Also like this video, do subscribe to the ET Money channel, and I look forward to catching up with you next week on another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.